So I'd like to welcome everybody to our 2018 Keystone's Investor Panel discussion. And I think as you can see from the setup, this really is intended to be as much of a fireside chat and a conversation as well as a presentation. So I would encourage everybody, to the extent you have questions or comments, feel free to make this a conversation. You're going to see shortly that this is part of the culture that we are working to inspire, and that this really is, but for you as an extension of our firm, you, our investors, you really add as much value to this firm as our firm should add to you. So that being said, I'd like to introduce all of you to my team on the stage. Probably everyone knows my partners, Mark Rash, Rich Gottlieb, our CFO, Tim Krieger. All the way down from Miami, I have Randy Johnson. Sorry about that, Randy. Last night was unfortunate for you. But Brad Krause was on the floor. So Randy runs our Southeast Division. Next to him, Robert Liu, one of our real senior talents on the team. On the other side, we have Jamie Rash. Yes, the last name is not a coincidence.
Stole my joke for later. Great.
I have larceny rights. But Jamie, as a regional director, this is actually not nepotism. His position is well earned. And next to him, we have one of the newest members of our team, Todd Monahan. Todd, another real veteran in the industry, and you're going to hear a bit from Todd. So this is the team or the panel, and I'd like to run through the agenda, what we'd like to cover today in the meeting. First, we'd like to give you a sense about Keystone. Keystone in size and in scale, and talk about where we've come, because 2017 for Keystone was a breakthrough year. It was a. Go back one on that slide. That's all right. We can go back one. She's good. Bill's going to jump around. Breakthrough year. Oh, the Eagles. Oh, by the way, Robert's a Patriot. Robert's a Patriots fan.
I just want to say thank God it's baseball season.
Sorry, Robert, but I'm not really sorry.
I know.
We had a breakthrough year for both Keystone and for our partners. And there were really three major breakthroughs this year. The first, which we described to you at the end of last year, was that we were able to buy out the limited partnership interests of our joint venture partner, Mac Cali, at a material discount, giving us 100% control and 100% of the economics of all of those properties. The second major breakthrough was in our second fund. And our second fund, we have settled a judgment with Wells Fargo Bank, where it enabled us, as of last year, we reported to you that there was no additional value in the second fund because of this judgment. This year, we can tell you we have a path to some recovery. And the third major breakthrough was internal, really strategic operational metamorphosis that Keystone has now transformed into a true full mixed-use developer. And these regional directors who I've indicated to you from the floor, they've got now full P&L responsibility, and we have some of the best talent in the market so that Keystone can grow at scale. All right, so it's that scale that we'd like to talk about. Again, the agenda, we'll talk about Keystone and give you a sense of the scale of the company in size, in investments, in people, in square footage, and where we're going first. Second thing we'll talk about is how we think about our business. So we want you to understand in detail how we view creating value in real assets so that you have context with how we deliver results, which is our third agenda item. We're going to talk about the results from 2017, and then finally we'll wrap up with 2018 and our path forward, our goals for 18, and where we see the markets and our execution going forward. So, that said, Stacy, I missed it already. So Stacy Dennis is the creative genius behind all the artwork on the walls, all the logos, all the website, and she has this spectacular logo, which is on all the water bottles, which is the Keystone 25. And I said to her, Stacy, there's only one problem. She did that 2 years ago for our 25th anniversary. So Keystone is 27 years in business. And 27 years in business with almost 3 decades of really terrific performance, with a couple bumps and bruises and one large fall in our second fund, but generally some really spectacular leaps through 3 decades. And that's enabled us to really get feedback from the market and from our strategies as to what worked, what didn't, what tactics are the most effective, and how to deliver the best risk-adjusted returns to you, to our partners. So first, Tim, maybe you can give a sense of scale in investments and in returns and track record to the investors.
Sure. Thanks, Bill. Good afternoon, everyone. Keystone presently manages over 30 discrete investment vehicles with a market value of over $2 billion. In 2017, our assets generated over $200 million of revenue. We presently have over 700 investors, which are comprised of high-wealth individuals as well as institutional investors, who have invested over $449 million and have received distributions of $340 million over the last 27 years. And we still have more to come. We're presently projecting there will be additional unrealized distributions of over $600 million.
Tim, that's a lot of investors. That's a lot of investments. And Amy Alexander, I think many of you know Amy. She's charged with handling all of this. Amy, how do we, with maximum transparency and effectiveness, communicate this to all of our partners?
Sure. Over 2 years ago, I announced to you, our investors, that we developed an investor web portal that's accessible through the Keystone Property Group website. In spirit of full transparency, you now have direct access to all of our financial and investment reporting, as well as all of the legal documents necessary for each investment, K-1s, and all pertinent notifications.
Amy, so the number one frequently asked question that you might get would be what?
What's my investment worth? Of course. Everyone wants to know what it's worth. So this is when I direct our investors to link into our investment snapshot on our website. It's a summary of each of your investments. It gives you your value of the investments on a quarterly basis. It gives you a summary of your contributions and distributions to date, as well as projected IRRs for the investments. And another actual, around this time of year, very popular question, how do we access our K-1s? You can get our K-1s right under the Documents tab, as well as our investment, quarterly investment reporting, all accessible on the website.
And for all of you, it's really simple. I can even do it. So if you have a problem or a question, just call Amy. She'll lead you through it, and you can get all your information at any time.
At any time, yeah, absolutely.
And Amy, if I'm mobile?
If you're mobile, we've got an app for that. Come see me after the meeting. We can get you set up on your phones. You got access to it 24/7. All the Keystone information available to you at all times.
Fabulous.
Yep.
So the transparency and the ability to access information unlimited, and for everybody here, to that end, so that we have so much information on the web and available to you that for this meeting, this will be a high-level view of the facts and the financials and everything, I mean everything, including the balance sheets for certain properties at Independence Mall West are all on the website. As of this morning, right? We got them done. Thank you, Joe. Thank you, Joe. So a robust offering in financial data, but Rich, maybe you can give everybody a sense of scale of the enterprise.
So we've grown in a number of different ways. We've grown with people. We're now over 130 people working for us, and candidly, that is our number one asset, the people who work for us. We love to create the culture for our tenants and for our employees of a collaborative environment, and we're really proud of the people we have. We've increased in square footage. With our development land, we're over 10 million feet, which is a significant portfolio by anyone's standards. And then with all the square footage, we do a lot of leasing. Last year, we did just under 2 million square feet of leasing last year, and it was a highly successful year as far as leasing. So we have this culture, we have these people, and we're growing. And Bill can't be everywhere, I can't be everywhere, Mark, Tim, and we need to keep an efficient operation. And that's what we've looked to do. So Bill alluded to, we have regional directors now, and you're going to be hearing from these people because we want you to see and know them. They're running the business, and they have a small team that works on their properties, different skill sets, whether it's accounting, property management, leasing, lease administration. They all work together. They know the assets, they understand the assets, and they're empowered to make decisions and move quickly because we never want to lose that entrepreneurial spirit.
And it's that culture, by the way, which is a good segue to the most probably important thing about our strategies, are how we think about our business. And it's very simple. We think about culture, strategy, and execution. Right? Now, a lot of people, and we've got a lot of very savvy business owners here in the room, you think about your business from the top down, or as we like to do it, from the bottom up. This is an alpha business. It's about blocking and tackling. Right? It really is about execution. It's about creating value. And as all of you know, you cannot have strong execution without a really sound strategy. So similar to a shooting at a target, you can't hit what you're shooting at if you don't have the right target. So our strategy then is compelling, but to get the right strategy, for those of you who are fans of the Peter Drucker book, Culture Eats Strategy for Breakfast, right? There is a strong business principle that says you should focus on your culture first. And to that end, you've heard about the culture we're building internally in Keystone, but also at our buildings, which you've seen a lot of them here, you've invested in a lot of them. You can see what we capture very nicely is the new thinking, not just in real estate, but in our economy. Because if the old paradigm of an office building or a headquarters was processing tasks like a factory, the new paradigm is unlocking people's creative potential, like a university. And if you think about how you all work today, I bet it has no resemblance to 10 years or 20 years ago, because you can work anywhere at any time. And what matters is the people around you and your ability to collaborate and have inspirational casual collisions among people. So the proof of concept of all of this came about last week. We have one of our properties downtown. We're approached by a multinational Australian asset manager that has sites all over the planet. And they became completely enamored with our property because of exactly this, the way we create a building culture that is so attractive. And the global head of real estate said, this is where we want to be. And he said, I will tell you that what we try to do around the world is create an experiential workplace, because that workplace environment, that drives our revenue more than anything else, any other metric that we have. Proof of concept. He didn't say, hey guys, you're $2 a square foot too high. He didn't say, well, we can't get enough people in here. It was the experiential workplace. He said it in Australian though, so it sounded a little cooler, but that's a 150,000 square foot tenant who will pay $3 million a year to have the right culture. So behind our culture is a strategy. Our strategy is simple. We reinvent real estate. Easy. And we just don't reinvent real estate for reinvention's sake. We reinvent real estate so that we can drive net operating income and further drive the net operating income multiplier. So the math becomes really compelling. When you compound driving your NOI by compounding by driving your NOI multiplier, you build dramatic value into the assets. That's our strategy. And our strategy works across a number of tactics. But by adding creativity and capital, you maximize the value to the assets. So how do we do it? And here's the execution part. And here's really the blocking and tackling. Right? It really is the tactics that we overlay onto this strategy that are what drive value for all the assets in the portfolio. And Rich, maybe you can give some, not just discussion around the tactics, but also some case studies that we're all invested in and show how it works in action.
Good. Thanks, Bill. So we've outlined 7 tactics today, some of which we use, many of which we use multiple in each particular asset. And these are a good set, and there's others, but these are the main tactics that we use. So the first one would be development. Of course, so we have land, and we build a new project. Sora West and Conshohocken is a great example of that. We're going to be, hopefully, we have approvals. We're hopefully building a large mixed-use project there. And Jamie Rash, I want to tell us a little about that.
Sure. Thanks, Rich. So back in 2013, we acquired what used to be known as Keystone River Crossing. Or sorry, 2003. Yeah, a long time ago. About 80,000 square feet of assets.
He was still in high school.
Well, I had my joke about us looking alike, and you ruined it earlier, and it just threw me off a little bit. So,
Before and after.
yeah, right. 35 years later. So we had 80,000 square feet of office buildings and a parking garage, and in 2013, the opportunity came up to acquire this parcel of ground here through an RFP process run by the township. And we were successful. We saw an opportunity to basically create a full block of real estate, which is basically Main and Conshohocken, one of the really most important sites in the region. So we were successful. We spent a couple years getting the site rezoned. We're about 6 months away from getting land development approvals that will basically allow us to go from 40 feet to 200 feet and build really a dynamic town center environment. Trophy office, 175 key hotel, street level retail, plaza, and then a really cool kind of firehouse that will turn into a gastropub. So what was a group of buildings that we bought for under $10 million is now we're looking to do a $300 million town center development. So pretty exciting.
Very exciting. Thank you. The next tactic that we deploy often is redevelopment. The best example of that today would be right across the street at 15 Kings Grant. And Robert, why don't you tell us a little about that?
And this is a Fund 3 investment, correct? Right. So we're going to profile probably a number of different funds, a number of different investments. Didn't mean to steal your thunder.
No, that's okay. That's okay. I'm still stinging from the Patriots comment. Anyways, Kings Grant is a 56,000 square foot building located here in Bala Cynwyd. And to really unlock the value, we didn't want to multi-tenant the building. So when you're not going to multi-tenant a building, you want to exhibit a lot of patience, which really means you've got to buy right. And that's one of the things that Bill and Rich constantly preach is buy right. So we bought this building for $64 a square foot, and then turned Scott Paymer loose to go out and find the tenant. He found a prospective tenant. He and Michael Brookshire, our head of construction, met with the tenant, customized the building, and in December we signed a full building lease with this tenant. And just about 3 weeks ago, we received the final approvals for the construction, and we'll deliver this building to Cardone, which is a remanufacturer of auto parts. And so in June of 2019, we'll deliver that building to them. Cardone is a creditworthy tenant. They are the largest remanufacturer of auto parts in the country. They have over 5,000 employees. This is their corporate headquarters building. They've been in Philadelphia for 50 years. And what's important about it is that it is a triple net lease starting over $30 a square foot with a 15-year term. And as a single tenant building, that means that the potential buyer for this building could be someone in California. This is not just a regional play or a local play. The entire market for a triple net triple net full tenant lease is national. So we see this building generating upwards of $500 a square foot on a sale, which translates into about $28 million. The all-in developmental cost will be under $22 million, which nets you over $6 million on the investment, which is a multiple of 3 times on the initial equity investment. It's not $330 million like Jamie has, but still we're pretty happy with a equity return of 3%, or 3 times on the equity investment.
You get us 3 times on every
Yes,
investment, nobody will throw you out.
Okay.
The next tactics we want to talk about is mixed use. We're a mixed use developer. I think our best example of that is the Curtis. And Todd, can you tell us a little about that?
Sure. Many of you are familiar with the Curtis Center. It's over 800,000 feet at 6th and Walnut, with frontage on both Independence Mall and Washington Square, which is tremendous. You know, it's got the beautiful atrium and the Maxfield Parish Tiffany mosaic. I know many of you are investors. And our vision is to create a dynamic 24-hour live, work, play environment, which a lot of employers are looking for, and residences. We've added key retail uses such as Cooperage Cafe and soon to open PJ Clark's at the corner of 6th and Walnut, which is going to be an incredible saloon that's going to enliven the corner of 6th and Walnut, which has been very quiet for a long time, and really create a destination. We've also introduced residential to the building, which is a bold vision, developing 63 units. We're 75% leased. I think there's 17 additional units that'll deliver in June, and we expect those at current pace to be leased by the end of the summer. The initial cost for those residential units, including the amenity center and the physical plant, was close to $500 a square foot. We're going to add additional residential due to the capacity of the physical plant and the capacity of the amenity center, quite frankly, probably under $300 a square foot. So we've added tremendous value there. And if there is a point in time when we refinance or sell, the cap rate on the residential is probably 5.5 versus the office, which might be 7 or 7.5. So we estimate conservatively there's an extra $17 million in value that we've created just in introducing the residential. And we expect an initial IRR of 19% and an equity multiple of over 2 times. So just a really exciting project, real game changer in East Market.
We're really happy. We also, the office space is doing well. We're about 86% leased there. We'll continue to increase that. And the apartments have kind of been beyond our expectations. The price keeps going up. And so we're very proud of that. The next tactic we wanted to talk about is rents to market. In Berwyn, we have Westlakes is a great example of that, and it's one of the tactics we've used there. And Jamie, can you tell us about that?
Sure. So Westlakes is part of the PA portfolio, the first Matt Cali acquisition back in 2013. When we bought it, it was just under 80% leased. Rents were kind of in the $23 to $24 range. Not a lot of activity. So we really saw an opportunity to bring the rents to market, if not above market, by executing on a capital renovation. So we spent about $4.5 million putting amenities, upgrading the common areas, creating kind of this collaborative environment that everybody up here is preaching. And the success has been great. We're a couple leases away from being 92% leased, and rents are now in the $28 to $29 a foot range. So really, speaks to what we did. As you can see on the screen, the NOI at acquisition was about $5.5 million. We're looking at a stabilized NOI of 8 and a value of 110. million. So this is split into Class A and Class B shares. Class A, we're looking at a 2-time multiple. And I assure you that's not a typo. Class B is a 37-time multiple on that valuation. So,
Right basis.
Wait, Jamie, you can just give that whole last part again. Just do a loop.
Class B is a 37-time multiple.
Yeah, that may be one of the highest percentage performers in Keystone's history to date.
And thanks. And so another opportunity, another tactic we use is a sale leaseback. We like buying from corporate users. They're not efficient, and we find a lot of value in that type of transaction. We recently bought in Miami, Florida, a building from AvMed, and Randy from Florida. He's a little sad, but he's from Florida, and he's here today. He'll tell us about that property.
Thanks again for the introduction, Rich and Bill. In 2017, we purchased Dayland Towers South, and this is directly adjacent to Dayland Towers North, which we've owned and operated since 2008. As Rich said, AvMed is they're a regional healthcare provider that had owned and operated the property for many, many years. The asset was extremely mismanaged and undervalued by AvMed. We had the opportunity to unlock this value through our professional management and leasing. We entered into a sale leaseback with AvMed for 102,000 square feet. The purchase price was $36 million or $157 a square foot. This was an off-market transaction. An illustration of the sub-market dynamics there is a recent sale of 9350 Financial Center. That project sold for $33 million or $313 a rentable square foot in November of 2017. At the time of purchase, AvMed was 79% leased, and the asking rates were $27 a square foot. Today, the project's 91% leased, and the asking rental rates are $30.50 a square foot. The original yield on cost was 7.2%. Today, it's 8.5%. We've received value estimates at $50 million, or approximately $220 a square foot.
And Randy, frame that for the partners. How much are we in? We bought it for $36 million, but how much are we into the property for today? North of $40 million or south?
It's a little, right around $40 million, Bill, just a hair under that, and that represents, and again, Eric's a little bit better than this. Eric Lee is a little better than I am, but it's approximately a 100% return on the investor's equity within 12 months.
And that yield will continue to go up as rental rates go up annually, which they naturally do in our leases. So it's a great story. It's going to continue to be a good story.
And I did want to just say one thing to the 76ers fans out there. I wanted to say congratulations on your win, but I won't, because I'm a sore loser and I'm all about winning, just like this is a winner.
Yeah.
Thank you.
And that's what we want in our shop. All about winning.
The next tactic we wanted to talk about was assemblage. The last property, we've done a little of that, but assemblage is when we buy multiple properties next to each other at different times so that 1 and 1 equals more than 2. And Viva in Bluebell is a good example of that. Jamie, that's another project you want to talk about?
Yeah, so Viva is comprised of 2 assets. 1777 we acquired back in 2004. Went through a strategic renovation, leased it up. We actually got back twice our equity. And then in 2011, we did a discounted no purchase and leased it back up again, refinanced it, got back, I think, almost 2.5 times our equity. So it's been a solid investment so far. We ran through some troubles recently where lost a bunch of larger tenants, but we're working back up thanks to the acquisition of 1618 right across the campus. We acquired that back in 2013. It's about 200,000 square feet. It gave us a 425,000 square foot block of space, which we were able to combine and kind of utilize all the kind kind of the power of each building to increase leasing. So what we did is we, again, kind of strategically underwent a renovation. We added amenities. We added this boulevard entrance that you see here, kind of connecting the campus, creating a sense of entrance. And since we've done all this, at the combined, thanks to Jake Francillo sitting in the back here, we've gone from 60% leased to 87% leased. And 2 assets that we bought combined for about $40 million are now at stabilization worth approximately $85 million. So like Rich said, this was a 1 + 1 = 3 easily.
So, and what you'll see is a theme, as we've made these investments and put all these great amenities in, and indoor spaces, outdoor spaces, this is what the tenants are looking for today. And we're creating a situation where the small tenant can have these big tenant features that everyone's looking for, and they attract and retain the best talent, and that's the theme of just about every employer we work with today. Next would be a yielding land play. Again, we buy a property that has a return and is operating today, but there's more yield on the land, more development opportunity. And here, where we are today, GSB is a great example of that. Robert, tell us a little about
Thank you.
GSB.
If I had my druthers, I'd ask you all to get up and go to the windows and tell me what you see, because you'd say, I see the city skyline, I see other buildings, I see the western suburbs. Well, what we saw was the untapped potential of the parking lot. Because a few years ago, Bala-Cynwyd did a zoning overlay, which allows additional density, relaxed height restrictions, and expanded the uses. So we entered into negotiations with the Newman Development Group, which is a multifamily housing developer, and we're going to sell that part of the parking lot to the Newman Group. Now, to execute that, we're going to convert the GSB property to 3 condo units: residential unit, office unit, which is the GSB building, and retail unit. We're going to sell the parking lot to the two other condos for $7.5 million. The GSB building itself, that condo unit, is going to retain an ownership interest in the retail or residential valued at about $2.5 million. So the parking lot, which you see outside this window, is really worth about $10 million. We feel that the stabilized equity investment in this project, this building, will be about $14 million. So you're going to have realized, you're going to have made back $10 million just on the dirt before you even start talking about the building. And that's a home run.
And we think that'll even make the GSB building more valuable, because we've created this mixed-use environment that's very desirable to a lot of tenants in the marketplace. And you don't get that in Bala-Cynwyd.
Larry.
We got a question in the back.
Larry, you have a question? So Larry's question, am I mic'd up? Great. Larry's question, great question. By the way, and Larry hits on the #1 issue in the mixed-use developments. Where are people going to park? Now, there's the short answer and the much longer answer. The short answer is that as part of the mixed-use zoning, well, Rich, why don't you talk about the mixed-use zoning?
So the mixed-use zoning uses a parking ratio that we look at a mixed-use parking of when people are using the parking. But the bottom line is that the new development will have to build a parking structure to not only accommodate the new uses, but also accommodate the parking spaces they're taking away from the original use.
That's at their cost, Larry.
Right,
So-
that's the short answer. The long answer is, in 5 to 10 years, you won't be driving a car. So you won't have to worry about it. You're going to have an autonomous electric vehicle. It's going to drop you off, so we won't need parking. We're going to need drop-off space. But that's a whole separate discussion, which is a lot of fun. Great question, though. Thank you. And rather, please keep throwing the questions as you think about them. So, Rich, have you covered?
We've covered our 7 tactics today.
Great. So what's important, and I kind of want to wrap this up and bring this back to what's important, is that you now should have a firm view of how we think about our business, how we execute on a business, and the strategy of driving net income and driving the net income multiplier. Again, that compound effect has created wonderful rewards for us, almost across the board.
Excuse me one second.
Yeah.
What it also does is it improves the quality of our tenants as well. And that's another way that we get better cap rate compression. So it's not just the length of the term or the rental rate, it's about the quality of tenancy, and quality tenants are attracted to quality buildings.
So with all of these case studies, you see how we really try to create value in the assets. And that has worked, again, for the better part of 3 decades. So we've had one glaring, in our history, one glaring exception to that, which was our second fund. And we're going to start talking about the performance of the funds and the investments. And I get to start with our biggest challenge. And so I'll share with you an anecdote about University of Pennsylvania Wharton School asks me to come back and teach a class for their MBA students on real estate entrepreneurship. And I get a classroom about this size with some of the brightest kids walking. They're just phenomenally intelligent. And I tell them all of them, every class, first thing, don't ask me about my great deals. Ask me about my biggest challenges. Because I think I might have learned a little bit from the great deals, or I might have thought that I learned a little bit. But man, did I learn oceans from the greatest challenges that we've had. And the global financial crisis for us was like 4 MBA sessions crammed into a couple very painful years. So the reason for this is because our second fund was caught squarely in the teeth of the global financial crisis. And as we now get more distance from the financial crisis and have a little more historical perspective, we really can see how bad it really was. It was the second worst financial crisis in US history. We got caught. So what happened was there was a judgment outstanding with Wells Fargo Bank going into 2017. It was a $53 million judgment. Because of that, we had $26 million in real assets. We reported to you that there was no additional capital available, there was no value left in the second fund, but that we would continue to fight to go get some recovery. And we succeeded on that. Now, Mark, can you give a little view on Wells, the resolution, and the resolution of the judgment?
Yeah, I mean, as we reported before, we fought Wells Fargo for probably 4 years. They had a $53 million judgment. We still had, and that really resulted from some properties in Chicago. We were successful in January to negotiate the settlement for $12 million, which we paid to Wells Fargo. So we now have complete control of the 5 remaining assets in Fund 2, of which we will be liquidating those this year. So Funds 1 and 2 will be terminated by the end of this year.
Okay, and Tim, so can you give us the numbers?
Sure. For Fund 2, we raised $111 million, and we projected that the total distribution will be $34 million. For Fund 2, if the assets were sold on December 31st, 2017, we have estimated that the market value is $19 million. Additionally, we have estimated that the LP's net asset value is $12 million.
Okay, so the net asset value at $12 million, I see you're carrying on the short-term notes that we had to buy out Wells, correct?
Correct.
Okay, so that's the difference between the value and the net value.
Yes.
Terrific. Okay, so, yeah, question? So the question is, what percentage is the remaining recovery? That's about 11%. Thank you. And to that point, by the way, what we also reported to you, as soon as we settled this judgment, we went right out. We wanted to try to create a liquidity event right away. So we reported that we interviewed all of the biggest brokerage houses in the marketplace. We selected Jones Lang LaSalle. They took out the entire portfolio for sale or for recapitalization, the whole portfolio. And the results that we got were less than we had expected. So Rich, do me a favor, can you tell the partners what at that time would have created the results that we got that were less, in some cases far less than we expected to yield?
Well, the timing was really just off. We have a number of properties with long-term debt that is not prepayable, and that is discounted by a prospective buyer. Also, there was a lot of uncertainty with our tenancy there. Each building had something going on. It seemed like at Valley Forge Park Place, our largest tenant had a termination option. That went through 3/31 of this year, so that has since passed.
And
now
they were like 40% of the whole property.
of
right?
the whole property, correct. 160,000 square feet, they were 58,000 feet. So that was a significant problem that someone was concerned about.
At that time.
At
in
that time.
2017.
Right, that was
And
17.
that's passed, right?
Correct.
Okay.
Correct. So that's not an issue today, and that's a property that we should be looking to sell now. At One Presidential, we have a very large tenant who's 40% of the building, wants to grow. We're still pretty well leased there. We need to show him a path of how they're going to do it. It's Hamilton Lane. They're a large company. They're public. They're doing great, well capitalized. We could. There's just no one would give us any value for the upside potential there. And
How
see
far
that.
were they looking to grow? So to get a sense of scale and in perspective, what this really means to the building and to the fund, they're going from 50,000 feet to 100?
Yeah, they'll commit to over time up to 100,000 feet
For how long of a lease?
Long-term lease.
with a 15-year. They want to do a 15-year lease.
Right.
So that is tremendous amount of value. Assuming we can get it done, we need to execute.
So at the time that we took this out, just to bring it all together, there was uncertainty within the assets around the leases, uncertainty to the downside with Valley Forge Park Place with a tenant with an expiration, a termination option, and uncertainty with the upside of Hamilton Lane that we should capture. And the prices that we got would not pay us for the upside and penalize us for the downside.
Right.
So our view is we fought so long and so hard to win back these assets that now we want to take our time and get you maximized value on the return. And we're going to try to do that all this year now that we're getting through most of the uncertainty.
And it-
Mitchell, also, we had Valley Forge Office Center.
correct. It's a tremendous. Do you have a question? I'm sorry.
The question is, we all invested in Fund 2 so many years ago, and you're expecting 11% recovery on what's left. So what approximately was the total loss on our original investment in this fund?
So the question is, what was the total loss on the investment? And Tom, do you have a question as well? So we can talk.
Well, that was estimated if you did it in 2017. The result that you're expecting with these leases is a different number, right?
Great point. So Tom asked the question, if that was the result that we expected, the value we expected at the end of 2017, the result that we should get should be better if we're able to capitalize on these. And that answer is absolutely yes. Astute point, thank you. And the total value, I think Tim gave you the total value. We've returned 20% of the initial capital. We think there's 11% more as of 12/31/17. So that'll give you a 69% loss if we sold everything at that point. So again, we're still fighting for every dollar into this asset.
Right. And in addition, Valley Forge Office Center has a lot of upside as well, and that had a tremendous amount of uncertainty. We are one of our largest tenants. Lease was coming up. We didn't know if we could keep them at the time. There was a couple other tenants that needed to be renewed. And Jamie could give us a whole story on where we are today.
Sure. So with Valley Forge Office Center, this is kind of like if you think back at the tactics, this was really a redevelopment rents to market play. We bought it for $20 million. It was about $90 a foot. It was actually 4 buildings at the time. And we underwent a substantial renovation, $20 million, and this is the 656 and 676 buildings. You can see we connected them with a large atrium and extended the footprint. We actually added about 35,000 square feet. So arguably one of our most impressive, if not our most beautiful renovation. And we were able to capitalize, market rents of the building were in the high teens at the time when we acquired it. When we were finished, we were pushing high 20s. As Rich mentioned, though, we had difficulties when we took this out to sell just because we had a lot of uncertainty with some of the longer-term leases and with the long-term loan in place. So a couple things have happened, though, since then. Not only have we extended all the major tenants out till at least 2023, but the market really took off as you can see, the King of Prussia Town Center, which was developed on an old golf course, really created a lot of excitement in the market. It brought retail, there's apartments now, there's medical, there's a Wegmans, which always creates excitement. And it really created a lot of vibrancy in the market. It drove up rental rates, it drove up occupancy. So we're really in a prime spot now. We've gone from 75% to 80% over the last 6 months. Rich Jones standing in the back's got a ton of leasing activity. So as these guys said earlier, we would have been foolish to sell it at a discount a year ago, because there's still a ton of value to unlock here. So we're looking at, when we're all said and done, a valuation of about 76 million, NOI of a little over 5 million, which is basically a 4 times growth from when we bought the buildings initially. So
When do you expect this to be 90% or more leased?
honestly, I think we'll be 90% probably end of year, beginning of 19. I mean, just with everything that's in the hopper now.
So I think you can see, as I said earlier, going through Fund 2 was like 4 MBAs crunched into one. It was challenging. If there are more questions about it, and well, any questions, I appreciate the questions we got.
Thank you.
If there are more questions, happy to hear them. We have a number of other investments to capture, so we'll be here to give further detail on Fund 2. But I would like to roll through Fund 3. Again, we have a number of great deal stories to tell. And one of the consistent themes I think you're going to hear, and one of the things we learned during the global financial crisis, is get as much risk capital off the table as soon as possible. And in Fund 3, so far we've returned 115% of the initial capital, and we still own 15 investments in the fund. And very specifically, this year we have properties within the fund that are in the market for sale today, and more that will be in the market for sale, because we fully intend to capitalize on the liquidity of a very good market right here, and we fully intend to take properties as they reach maturity and sell them. So if you can, Tim, first give us the numbers.
Sure. For Fund 3, we raised $58 million, and we projected that the total distributions will be $104 million, yielding a net LP equity multiple of 1.8 times. For Fund 3, if the assets were sold on December 31st, 2017, we have estimated that the Fund 3's net asset value is $36 million. Please note that we are showing GSB and One Washington at cost.
Okay, so at cost, and again, this is everything at 12/31/17, no future cash flow into 2018, no future appreciation into 2018, correct?
Correct.
Okay, great, thank you. So, so we talked about GSB and carrying GSB at cost, and Robert, I think you gave us a hint that there's a lot of value to go harvest here.
Yeah,
Can you
yeah.
profile
Absolutely.
that?
Yeah, absolutely. Thank you, Bill. Rich touched upon these 7 tactics that we use to add value, and GSB itself almost touches all of them. We talked a little bit about the land play. Then we've also got the assemblage play with 225, which we're going to look at possibly rolling in so we can control the entire city block and truly cultivate a live, work, play environment that's not here currently in Bala. And then, of course, we talk about trying to rent the building itself. Now, to rent the building, and going back again to what Rich had touched upon about quality tenants, we needed to invest money into the building. And our total investment in the building was about $13 million in terms of capital improvement projects, starting with the garage, the lobbies, the hallways, the corridors, the restrooms, the elevators, you name it, we touched it here in this building. But when you do that, of course, you want a return on that money. And so the next step, of course, is to push rents. And anytime you push rents in a development project, you're going to lose some tenants. So we're at 80% right now occupancy. We fully expect to drop down to about 75% before year end, before we're actually able to turn this around. But that's what the entire play is. That's how you execute. And a perfect example is the floor we're all sitting on here right now today. This floor was leased until December 31st of 2017 at a rental rate of $22.50 a square feet. Lee has already released the entire floor to an existing tenant in the building that recognized the value of the improvements. It's an existing tenant that's expanding by 70%, and they're going to come in, start paying $28 a square foot. That's
28?
a rent, $28 a square foot.
So from 22 to
From
28.
22.50 to 28.
25%
Exactly.
jump, okay.
Exactly. So at stabilization, we feel that we can push the NOI up to about $5 million, which translates into a value of roughly $68 to $70 million. That's about a 1.65 equity multiplier. And if I was still teaching, I'd give you guys a pop quiz, but I'm not. So I'm going to tell you what that 1.65 equity multiplier is missing. It's missing the $10 million from the parking lot. Okay? So the equity multiplier is actually about 2.2, maybe 2.5 at the end of the day. So again, a home run of a redevelopment touching upon almost all of the tactics that we use here at Keystone.
And we believe in the future development of the apartments and everything, so we'll have an investment in those future apartments, and there's a possibility that investment goes up over time as well. We would expect it to.
Great asset. Thank you, Robert. Any other questions for Fund 3? Question on Fund 3, we're going to keep rolling forward. The Pennsylvania portfolio was the first portfolio that we purchased from Mac Cali in 2013. And true to the themes that we're going to continue to talk to you about, we want to get as much risk capital off the table as quickly as possible. We've returned over 71% of your initial capital just in cash flow. We've one little refinance in there, but almost entirely in cash flow. And we still own 100% of the assets, and we have several assets targeted for sale this year. So, Tim, can you do the numbers?
Sure. For a PA portfolio, we raised $36.7 million. We have projected that the total distributions will be $93 million, yielding a net LP equity multiple of 2.6 times. With the Class A shares, we raised $34 million and have projected that the total distributions will be $62 million, yielding a net LP equity multiple of 1.82 times. With the Class B shares, we raised $2.7 million and we projected that the total distributions will be $31 million, yielding a net LP equity multiple of 14.53 times. Extraordinary, right, Bill?
We'll take it. You can say
I
that
get
again.
excited about that. I don't get excited. I get excited about that. The reason that the equity multiple for the Class B shares is so much higher than the Class A shares is that the Class B shares purchased Mac Cali's $22 million interest for a bargain price of $2.7 million. For PA portfolio, if the assets were sold on December 31st, 2017, we have estimated the net asset value is $69 million. The value of the Class A shares is projected to be $38 million, and the value of the Class B shares is projected to be $31 million.
Terrific. Thank you. And it's worth profiling. For each one of the investments, we're profiling one of the standout investments. The one we'd like to profile is one that I did not believe in, and I'm going to confess in front of everybody here today that I was wrong and Jamie Rash was right. I did not have the confidence to invest more capital into this asset within the portfolio. I didn't see the turnaround story. He did. He and Rich convinced me this was the play to make, and boy, were they right. So, Jamie, you can...
Thanks, Bill. We're going to leave this up there the whole time. We have other slides, but I don't see a point in putting them up. This was a great story. So 4 and 5 was, we call it 2 outlier assets in the PA portfolio, 4 and 5 and 1000 Madison. It was 45% leased when we bought it. Rents were in the high teens. Our largest tenant who was 50% of the occupancy, actually really had 1 foot out the door. We underwent a real strategic renovation at 4th Century. This used to be my grandmother's house, and then now we have this really exciting lobby on my mother's side, not his mother. At 5 Century East, we took what was a really tired building. We expanded the lobby, created a 2-story atrium lobby. We created a whole suite of amenities, lounge spaces, indoor and outdoor, and increased rents from the high teens to the mid-20s. Occupancy now is over 90%. And this is kind of poised for a sale and a liquidation. So when we bought it, we were at a $1.1 million NOI. We bought it for just under $17 million. We're now at a $2.9 million NOI. looking at a projected sale value of about $37 million. It's a 2.1 multiple, and again, not a misprint. It's a 21% multiple for the Class B guys. So
No, 21
sorry,
times.
21 times multiple, yeah. So it's even better. So again, really excited. And Madison, just to know, we're also getting ready to take that out to the market. We're almost wrapping up a lease with the Attorney General that's taken almost 2 years.
Larry has a question.
If anyone needs liquidity on their Class B, I'm willing to pay 3x.
So for everybody here, to the extent you need liquidity for your Class B shares, there is a standing offer from one of our key investors that will take you at it 3 times your initial investment interest. And that offer is good for, it's good at least 1 week.
I'll do,
So
I'll do 4 times. So,
Jamie, this isn't a bid, this
No,
is
it's
a
not.
standing offer. Right?
Rich,
Joe, question, yeah.
Are those values reflected on the website in the investment snapshots?
The question is, are these values reflected on the website in the investment snapshot? And the answer is yes. So all of these metrics, and we can do a deep dive into cost basis, where we bought it, the capital that was invested that I didn't believe in that Jamie did. Jamie was right, I was wrong, and because the results will speak for themselves. And again, part of the theme that we're talking about, when we have one more lease to finish buttoning up, and this goes out to the market and will be sold. Right.
And we have some other opportunities in the portfolio as well. Jamie mentioned 1000 Madison. We've been working for 2 years now. Rich has been trying to get the Attorney General to renew their lease, and they've been on month to month for 2 years now. The state is a rather difficult place to do business. But that should happen very soon. We feel like we're very, very close, and that would allow that asset to be sold. And then finally, we're working very hard on renewing our tenant at the airport. Our major tenant at the airport will do some redevelopment, but that's a 375,000 square foot tenant that would like to do a long-term lease. So tremendous value.
Terrific. Any other questions on the Pennsylvania portfolio? We'll roll forward into the tri-state portfolio. It was our second bulk purchase from Mack Cali, and these properties in New Jersey, New York, Connecticut, similar theme to what you've been hearing. We've returned over 42% of your initial invested capital just from cash flow, have not sold or refinanced any assets. This was a year later, so hasn't had quite as much time as the Pennsylvania portfolio to mature. But clearly, we anticipate the cash flow to continue in 2018 and for capital events as we look to sell assets here. Do have one set of lowlights, and this is the only lowlight outside of our second fund that I have to report on, Taxter, Talleyrand, and Soundview, which were, by the way, 3 of our smallest investments in this fund. We are going to take a loss on those. Now those, we had to buy the entire portfolio. So as part of the entire portfolio, we had to buy properties that were in Westchester County and Stamford, Connecticut, that were risky markets. And we knew that going in. We tried to hedge what we could and capture all the upside. Unfortunately, like option money, our option expired without full value. We invested $3.8 million into the 3 assets. We had realized $1.5 million out of cash flow from the assets. We still have cash at the properties, about $400,000. So we expect to lose $1.9 million in the fund. That's about 7.8% of the total $28 million that we raised. The rest of the capital has all gone to the rest of the properties where we can really use Keystone's strategy and tactics that we described to you earlier today. So I have one other note of caution. It's a yellow flag, but one cautionary note on 30 Knightsbridge. We're taking a more sober view of value on that asset for only one reason. The largest tenant in 30 Knightsbridge is AT&T, and their lease expires at the end of 2019. And because we have no visibility on what happens with the AT&T lease today, and because it's 40% of the asset, we're taking a very sober and measured view of what we're reporting to you as value today. We'll give you detail around that in a second. So with those two caveats, Tim, can you give us the numbers?
Sure. For Keystone Tri-State Opportunity Fund, we raised $31 million, and we projected that the total distributions will be $44 million, yielding a net LP equity multiple of 1.41 times. The Class A shares, we raised $28 million, and we projected that total distributions will be $37 million, yielding a net LP equity multiple of 1.3 times. The Class B shares raised $3 million, and we projected the total distributions will be $7 million, yielding a net LP equity multiple of 2.4 times. For Keystone Tri-State Opportunity Fund, if the assets were sold on December 31st, 2017, we have estimated that the net asset value is $33 million. The value of the Class A shares is projected to be $26 million. The value of the Class B shares are projected to be $7 million.
Great. Thanks, Tim. So, Robert, can you give us, maybe expand on what I was talking about for 30 Knightsbridge with AT&T, and then talk about kind of the big winner that we have in the portfolio at 412?
Sure.
on Kimball.
Yeah, thank you, Bill. The AT&T lease is somewhat of a curse and a blessing. It's, again, as Bill said, 275,000 square feet. The curse part of it is that they're very difficult to deal with, and they've only been renewing 1 to 2 years at a time, and it's very hard to add long-term value to the asset when they're only renewing 1 to 2 years at a time. The blessing part of it is that we have AT&T in 275,000 square feet paying rent. The other part of the blessing is that they're in 275,000 square feet at a below market rate, so that if they were to leave, we believe we can see significant rent appreciation, and the project is still very well capitalized to take advantage of that. We have strong leasing activity, and one of the real quick wins is that we finally, after 3 years, have Rutgers coming into one of the buildings. Now, it's only 6,000 square feet. But if you were to stand on the rooftop of Knightsbridge, you could stand and look down and see they look like little ants walking across the street because they're in the building next door as well. And they come to our building to use our amenities, which from day one we've encouraged them to do. So we feel long-term that if AT&T were to vacate, we'd have a great shot at talking Rutgers into taking more space in the building. Other pluses, on Monday it was announced that Knightsbridge won the Toby Award, which is the annual award given out by BOMA, is the best corporate center in that North Jersey market. And based on Jessica Runyon's optimism, we've raised distributions from $175,000 a month to $238,000 a month. So while we're being prudent and cautious on the value, it's still a great asset and still performing very, very well for us. With respect to 412,
How occupied are we over there? Just,
94%.
yeah, so-
Right now, we're 94%. Okay. At 412, it's a great case study because it is a big building. Now, it's a 480,000 square foot building. People say, they say building that size all the time. It's only 3 stories. So when you think about 3-story, 480,000 square foot building, that's 160,000 square foot floor plate. It was very daunting for users of the building. It was very daunting for brokers, who one of the complaints of the brokerage community was that they would get lost. They'd come in for a tour and they'd actually get lost in the building. And because of that, it was at 70% occupancy and tenants were leaving. So Tom Sklow had a vision of playing on its location up in Morristown, New Jersey, of taking into account its proximity to New York City, and re-identified the building figuratively, divided into 3 separate buildings with an uptown, midtown, downtown theme. Separate signage, separate lighting schemes, separate entrances, and it's been an absolute home run. He built out a phenomenal fitness center. Each building has its own conference center or training room, which is, again, we talked about Stacy with the wall murals. These beautiful murals all tied into whether it's a midtown location, uptown location, or downtown location. Currently, we're at 85% leased. We see a path forward to getting to a $6 million NOI. And again, when we bought it, it was at $3.5 million. And a $6 million NOI, we believe that translates roughly into a $70 to $74 million equity investment, which is about a 1.7 equity multiplier. So again, it's a great asset. Tom and the team have done a great job repositioning it in the marketplace.
Any questions?
Thank you, Robert. Any other questions on Tri-State while we're here? I'm going to roll forward, come back to Philadelphia, and talk about two investments together. The Curtis and the Washington. Why they're together is because we've really, literally cornered the market on Washington Square. And we've been tickled with these investments. For now, however, as we continue to execute on the development, it's still early days in the development, so we're going to be carrying these at cost, right, Tim? So Tim, can you do the numbers and where are we carrying these at cost?
Sure. For Curtis, we raised $49 million, and as you mentioned, we're showing the net LP asset value at cost. The Class C shares raised $21 million, and the proceeds were primarily used to purchase a 42% interest in the property from Matt Calley. For the Washington, we raised $31 million, and as you mentioned, we're showing the LP net asset value at cost as well.
Terrific. So as I said earlier, we brought Todd Monahan to join the firm. He is a seasoned veteran, came from Jones Lang LaSalle. He had formerly spent a lot of time with Equity Office. Todd is new to Keystone, but not new to the Philadelphia marketplace. He is one of the absolute veterans of the marketplace. So Todd, can you give our partners your view on where we take these assets?
Sure, thanks, Bill. Yeah, I get so excited thinking about these two assets. I've known them for longer than I care to tell. I think I cold called One Wash in my early 20s at one point, a long time ago. And this is what gets me excited, gets me up in the morning. And, you know, if I think about these, really personifies yet another tactic a lot of developers or owners like to employ if they can, and that's to obtain dominant market share. You know, we got 1.6 million feet in these two assets, looking at Independence Park as well as Washington Square. It's just incredible market share and really an opportunity to transform the Washington Square neighborhood, which, as we've seen, is really, I think, undeveloped. You think about Rittenhouse Square and all the retail and the restaurants, and it's really been maximized. Yet this has been a sleepy square with no retail in the Washington and no retail at the Curtis. So there's an amazing opportunity to kind of transform the neighborhood, bring in new uses, new retail. We talked about PJ Clark's, which will go at the corner, 6th and Walnut, which is really going to stimulate activity and street vibrancy. We're going to bring new retail to the Washington, where it's never been before. And we're talking to a number of users there, including a gourmet grocer, which will create that sense of destination and the kind of place where employers want to come. Both assets are about 86% leased from an office perspective, and we have great prospects on the remaining vacancy. Another thing we're looking at is create a rooftop bar on the Washington, which would have this view. Again, creating the type of place where employers want to be, because we're in a war for talent, and employers want space that is dramatic, it's different, so they can recruit and retain talent. And both these assets have soaring ceilings, large historic windows with great views, and you can command a premium. So we're really creating a lot of value. We talked about the residential before, about the Curtis. We're going to add additional residential units at a much lower cost basis because of the physical plant that's already in place. So we just see tremendous upside and opportunity to drive NOI, increase rents, and ultimately our equity multiplier.
Great, thanks. So any questions on the Curtis, on the Washington, what's happening there? Certainly invite everybody here. This is a great story here at GSB, and it's great to see. That's a great story to see downtown. So moving forward, I want to talk to you about what we're doing in 2018, our view going forward. Ted, I have a question, yeah. Question from Ted, when do you expect distributions to begin on Curtis? So we had targeted, in our PPM, we thought by the end of the third quarter, we thought realistically we'd be done the construction development. We've had some, not surprisingly, construction delays in the residential, put us back a couple months. So I would say late fourth quarter of this year or early first quarter is when we should have everything done, leased, occupied, and cash flowing. Question for you?
Are these projects still open to new investors, or are they closed and you're
The question is, are these projects still open to new investors, or are they closed? So I want to, great question, thank you. I want to answer that specifically, and you helped me, by the way, segue to my broader question generally about investing with Keystone. So currently they're fully capitalized, but as you heard Todd describe, we have the ability to continue to expand the residential development, and we'll probably have another offering of equity to capitalize future residential development. And the math, the rough math, if it costs us $200 to $250 a square foot to build each incremental unit, right, because we have all the money in the infrastructure, and our yields are approximately $35 to $40 a square foot, you're talking about an unleveraged yield of 15 to 20% for every incremental dollar. So we think that's a very compelling investment for all of our partners. And as you all know, but I'll say it again, our investors get first preference. So the investors in the investment get the first preference to add additional capital. Investors in the Keystone family will get next preference. So we'll extend the offer to invest and keep going until the property is sold out or the investment sold out. And then, Mark, if we have anything left, who gets to take it?
Well, there'll be some outside investors that have asked about certain deals also that haven't been on it. Yeah, haven't been with us, and we'll talk to them next.
Tom, a question?
Keystone 2 Summit.
Tom has a question about Keystone 2 Summit, which was our another investment. We said we had 30 investments, haven't been able to hit them all. This is a sidecar investment when we had to sell the Fund 2 interest in our Pittsburgh asset. We sold the asset and retained an 11% interest. We sold that to Colony North Star. They paid, if my memory is good, wasn't prepped for this, $107 million for something that we paid. Matt Siegel's here, he can probably tell me, $48 million. I think I'm right. I mean, it was a 4x return. And then the Keystone Summit investors made, I'm going off the top of my head, don't quote me, 2.8 times.
I don't remember.
I'm going to guess on the Summit. It's still cash flowing. That investment will turn on whether Hines renews. That's the cash flow will turn on that. And Rich, you got news recently from Hines?
Right, we've been following it. Hines, as you know, it's now really a much bigger company. But Hines is just had their CEO come through in the last week, and he approved them to go forward with some capital improvements to the building. They also have an R&D plant in there. So we're feeling pretty good that they're going to renew, and that'll help us because there's potential cash trap if they don't renew by, I think it's November of this year. That's not necessarily terrible. I think they will renew. We're very, very keen on trying to get them to renew before that period of time, so it continues the cash flow.
Tom, we'll work up something in that for you this week or next week so you can see that.
But it's still a fully leased, 100% leased asset. We have a couple of tenants in the asset who are potential expansions. It's always been my happy place whenever I would go there. It just always did well.
Great. Any other questions? And to Tom's point on any investment, we have a number of them here. Any other questions at all? And certainly happy to take them offline. You can test our knowledge here on the stage or test our knowledge one-on-one. But I think one more question back there. Yeah. Four speed questions. He's got 4 questions. He needs 4 quick answers. Speed questions.
Inflation on capital costs. Are you seeing your labor materials costs rising? How is that impacting your CapEx?
Love it. Not a quick. So the question is, inflation into capital items. And by the way, we should also say, especially because I think today the 10-year went over 3%. So it's a very germane question right now. And what does that do to the investment? So Rich, maybe you can hit real quickly inflation. What are we experiencing into the homes building costs?
The big pressure we're having is construction costs. They continue to go up, the supply and demand. I'm hopeful that it'll level off now because you don't see as many cranes as you did a year ago, and the big rush for all, there was a demand for labor that could not be met, frankly. But it continues to go up, and that's a big pressure. So the tenants are asking us to fund more tenant improvement dollars, or pushing us. They're willing to pay rent, but they're asking for more tenant improvement dollars. For the capital, I would like to.
Yeah, and then a lot of times that extra dollars get amortized into the rent. And a lot of times when you see that kind of increase, you're going to see increased rents also.
Yeah.
Great question. We like macro questions. Second one.
Second one is net effective rents. I think you sort of led to that. So as base rates are going up, are net effective rents moving in that same direction, or is concessions and capital costs dragging that on?
Very astute question. This is an insider's question. The question is,
He's also a developer.
Yeah. So the question is, what's happening with net effective rents, even as we're experiencing higher rates? So we are all invested, fortunately, in almost an inflation hedge, or it should be perceived as an inflation hedge in real estate. And the hedge is where typically you fix or hedge your interest rates, and as the economy inflates, you get higher rental rates. Right, so that your rental rates, even though your costs are going up, rental rates are matching or exceeding those, and we're experiencing that real time. So but this question is more nuanced than that. This question is really about the net effective rates. In other words, guys, don't tell me that you're getting higher rental rates, face rate. How much are you spending? How much more do you have to spend to go capture that revenue? How much more are your operating expenses, right? And so what is the true net increase or decrease that you're experiencing? Right? Did I capture the question? Great. I have no idea. You got to ask an expert.
One thing I did want to say, that we're cognizant of the expenses going up, and what we've actually been doing was moving from a gross lease to a net lease form. And we're not getting as much resistance as I would have expected, frankly. But we want to hedge against that and put that pressure, or put that risk, I should say, back onto the tenant.
Great answer. And Rich's answer is the right answer. He's the expert that I was referring to.
The last question on cap rate, Bill. You just talked about the 10-year moving north.
Yes.
And cap rates tend to lag that. So when you do your valuations and your reversion cap rates, are you going to start trending those higher, or where do you see cap rates going?
Another great question. The question is cap rates, which are that net income multiplier that I discussed at the outset. Cap rates typically lag interest rates increases, and typically will lag. And question is, how do you forecast in our valuation? So as we report to you, how do we think about cap rates? So
yeah, I mean,
Mark,
on our final sales assumptions, we're increasing our cap rates. So we're taking into account that we think those will creep up also.
So, and specifically to your answer, it's about 100 basis points that we view outside of, where would trade today.
Jay?
Question, Jay?
Bill, regarding Fund 2 and those investors looking at, with a divestment of 69% loss, is there, given one presidential, given the lower variance overlay, given 225 City Avenue, is there a development upside rather than taking an 11% additional return on capital? Is it worth staying involved in looking at a development upside of these properties?
This is a great question from Jay. Let me repeat the question. The question is, with the challenges that we've been through in our second fund, and we have two spectacular assets remaining. One of them is one presidential. And the question is it worth selling that in advance of capitalizing on all the great things that are happening along City Avenue in Bala Cynwyd on Route 1, with development upside and the upside of, as Rich said, a possible 15-year lease with our anchor tenant. It's a great question because I think I answered a part of it, which I'll repeat, and I want to answer the rest of it here. The first part, which I would repeat, is that when we initially took it out and the feedback loop we got from the marketplace was they weren't going to pay us for all that upside. And I said, we already own the risk. Why would we sell away the risk to let somebody else go make 2 times or 3 times their money and go capture all the upside? We own it, so we want to capitalize on it. That's the first part. And the second part is how do we capitalize on it in a time frame, because we do want to give liquidity events and liquidity options, and we may need more capital if we're going to go do a development. And Mark, I'll let you speak to how we're thinking about that.
We've absolutely thought about that. And there's a good likelihood that a project like that in Valley Forge Office Center, we see a lot more upside because of what's happening around there, and you said in Ballacue, and possibly 225. We are contemplating some kind of recapitalization of which the Fund 2 investors would all have the opportunity to stay in, and those who don't want to stay in would get bought out, and we'll get broker opinion values. And Valley Forge Park Place is kind of, like Jamie says, kind of at that peak now. That's one that's worth selling. But the others, we think that we'll be able to create a capital event, and if you want to stay in, the Fund 2 investors will have the first options to take their part, whatever parts are left over. And again, if there's anything left over, we'll bring it outside. I will tell you that we are very confident that we would stay in for everything that we have in those deals.
Thanks for the question, Jay. Great questions. Any other questions on any investments? Terrific. Well, I would like to wrap this up by saying 2 things. One is I'm truly humbled and really appreciate all of the confidence that you give in us and your support, and that's immensely meaningful to all of us. So I want to thank you for that, and I invite everybody to stay after with us. We're going to have cocktails, and we can mix and mingle with some of the really strategic partners. So thank you all.
Thank you.
Thanks for the year. Thank you.